I'm Taylor Riggs in for Emily Chang, and this is the best of Bloomberg Technology, where we bring you all of our top interviews from this week in tech. Coming up in the next hour, Uber sinks. Shares fall to a record low this week as the ride-hailing company's lockup period ends. But is the worst over? We have analyst insight. Plus, the happiest place on earth. Media giant Disney releases earnings its last before the Disney streaming service becomes available. More on the company's outlook and global reach. And hack away. The U.S. government says Russia, China, and Iran will seek to meddle in the U.S. elections going forward. How vulnerable are we? We get opinions from two ethical hackers in our electioneering series. It was a week of reckoning for Uber. The ride-hailing company's post-IPO selling restrictions for early investors lifted Wednesday, making it one of the most actively traded stocks. Shares saw record lows this week. It is not a good look for the year's largest U.S. IPO. The stock is down 40% from its May debut. For some perspective, I caught up with Bloomberg Technology's Lizette Chapman and Lightshed partner Walter Piecyk.
A lot of people are just sick of waiting around for it to get better, and so we saw the stock fall. And again, there are some questions around whether this could continue, considering that a number of the very early investors are not yet are not underwater, and they could see potential upside.
Walter, the volatility today, is this a day's issue, a week's issue, or a months-long issue? I
mean, the average daily volume is 15 million shares, as Lizette was saying. You're talking about 1 billion shares that are coming off of lockup. So, I mean, some of those shares are probably not going to trade. I don't think SoftBank, who owns about 200 million or so of the shares, is planning on selling anytime soon. They're pretty bullish on rideshare and have a number of investments. But there's some, the founders of the company, we'll see what they're planning on doing. There's some early venture investors in there as well. There's a host of other of investors. So it could take more than just a couple of days, I think, to digest through this.
Lizette, I want to take a look at a chart that I'm showing for our Bloomberg audience inside my terminal, and it is the bearish sentiment around this stock that we've seen recently. There's 1.4 puts for every call, which shows more bearish sentiment as we were heading into this. Put that bearish sentiment into perspective for us. We knew that this day was going to come. Do we expect more downside risk ahead? What are investors saying?
Investors are also taking their cue from the results of Uber, who reported on Monday. And at that time, it was mixed, it was noisy, and the upshot were a couple of things. One of them was that the growth was the slowest at 29% a quarter than has ever been reported since the company began sharing that number. That's not a good thing, because this is a company that has always sold investors on its growth potential as it went to 60 plus countries and entered things outside of its core ride hailing into grocery delivery, autonomous driving, helicopters, gig worker matching, etc. So that's one thing. And whether it's going to continue or not, anyone's guess. I know that a lot of people focused on the fact that it projected it would be EBITDA profitable by Q4 2021. That's a number that's a projection that has never been shared before, and I was supposedly to reassure investors, but it doesn't seem like it worked.
Walter, give me your take here. Does the bearish sentiment line up with the fundamentals that we got from the company this week?
I mean, part of it, like the sell-off in these types of stocks, is not just happening the last couple of days or weeks. It's been going on for months now, right? Whether you call it growth, momentum, unicorn type stocks, there's just been a disfavor, and there's no positive catalyst on the horizon for this company to turn that. I mean, the Eats business and the incremental competition that they're feeling, which resulted in a deceleration of growth, which is an incremental negative, that doesn't seem like it's going to stop anytime soon. And I think that catalyst of saying, hey, we're going to reach profitability in 2021 was probably wasted ahead of what was $1 billion shares coming off of lockup. It's still questionable whether they can actually hit that target. So in the meantime, you've got a competitive Eats business. You don't have autonomy coming as a potential catalyst I think, anytime soon. So it's just hard for investors to own these types of names when you're relying on things like revenue multiples to base your valuation.
Walter, I have a little bit of a bone to pick when we talk about adjusted EBITDA, meaning the company's profitable. And to be clear, right, we're not talking about net income or an absolute bottom line profitability. Are you okay with adjusted EBITDA being positive by 2021, or would you like to see that translate down into net income?
I mean, I'm fine with it. I'm sure most investors that invest in these types of names are going to be fine with it. I know it makes for better headlines to focus on a net income number, but the reality is that EBITDA represents the cash, or more closely associates with the cash generation of the company. You also have to look if it's a capital intense business, which this business is not. So if they can get to that positive EBITDA, you're going to find a broader group of investors that are willing to invest in this name and put multiples on EBITDA rather than relying on a multiple of revenue or bookings.
That was my chat on Uber with Bloomberg's Lizette Chapman and Lightshed's Walter Piecyk. Now, Walter stuck around as we dived into Uber investor SoftBank, where things there aren't much better. The Japanese tech giant reported an enormous earnings loss, including a $6.5 billion in companies like Uber and co-working space WeWork. Japanese billionaire SoftBank chairman Masayoshi Son, however, remained defiant, saying he will make WeWork profitable. Lightshed's Piecyk gave us his take.
Based on Masa's math, he's still up on the Vision Fund. I mean, they've booked up to this point over $15 billion of unrealized gains. So this was a big setback. The write-down in the Vision Fund in aggregate was $9 billion. So it was more than just what was happening at WeWork. It was also Uber, and there's a couple of other billion of write-downs that occurred. But overall, according to his numbers, he's still up on the Vision Fund. And he looks at this and says, look, we'll have 15 massive winners. We'll have 15 awful losers, which I guess WeWork will probably be within that group. And then we'll have all the rest that are kind of doing so-so. And so his investment style, as he discussed today, is more about having these massive winners, like he had with Alibaba, putting in 20 million. It's worth, whatever, how many billions now, 100 billion now, in order to drive the returns there. So I think Masa, while they're talking about a more conservative investment style, is sticking to what he really wants to do, which is find really big winners to drive the returns for the company. Look, the bigger issue for that company with, this is kind of a sideshow, is they've got a big deal that's out there right now that's getting challenged by state AGs. T-Mobile is trying to buy Sprint. Sprint's a cash burning company with a ton of debt that SoftBank is the majority owner of. The court is still, they have to go to court. If they lose that, they're kind of stuck with Sprint, which would be bad. So if that deal can get approved, if T-Mobile can buy Sprint and get that off of his back, he removes all that debt from his balance sheet. He's got a great asset in T-Mobile that he can then borrow against and invest in the Vision Fund, and I think it gets SoftBank back on track. So a lot of what SoftBank investors should be looking at right now is how that Sprint court case is going to go with the state AGs, because that could be a big catalyst for the stock.
Well, and Walter, you're rightfully so. I mean, second sentence of your note that's hot off the press says that Sprint T-Mobile deal is the biggest catalyst for the stock this year. Is that what you need to see to sort of not save the company? That sounds too drastic, but to really get that stock to move to the next leg higher.
I mean, SoftBank has a lot of things going for it in terms of investments. So there's other things that can help. 2/3 of the investments in their portfolio, they were the last guy that invested in it. So if through an IPO or maybe another round of investing in the private markets, you can get some third-party validation for some of these investments, I think that would also help SoftBank. Maybe if Uber, we talked about that in the last segment, if Uber can stabilize the Eats business and find some way to growth, bring back some of those growth investors, that would also provide more credibility. Right now, they're losing a couple of $2 billion on the Uber investment. So any validation of his investments, or the valuations, any validation of the valuations that he has set on his investments, or a favorable turnout in terms of T-Mobile being able to buy Sprint, either of those things, I think could be a very positive catalyst for a stock that really is still trading at probably a discount, no matter how conservative you are in terms of marking their investment style, probably still trading at a discount to the value of those assets. Let's not forget that Alibaba is still a massive investment that SoftBank has, and really, I think, supports the overall valuation of this company.
Walter, your general thoughts on SoftBank and the Vision Fund's sort of decision to put more money at WeWork. Some people have called it putting more money at other bad money. Your take?
I mean, Masa was insistent today that it was not a bailout to save a bad investment, but it certainly looks that way. I mean, you took a company that was valued at $47 billion and you put new money in at less than $8 billion. So to me, that sounded like a company that was pretty desperate. I don't think it's a good sign in terms of the investments. And look, it was SoftBank making the investment as opposed to the Vision Fund. So that also tells you that their Vision Fund partners, which they're hoping to sign up to the second Vision Fund, weren't willing to come in as the investor to effectively bail out WeWork. They were already in a portion of it. They were effectively willing to let that investment kind of go. This money came from SoftBank. The question then is, let's say Sprint faces the same issues. Let's say the T-Mobile Sprint deal fails. Is SoftBank going to come into Sprint and have to write another $10 billion check to help Sprint out? I mean, Sprint's a company that's burning money that needs to invest in their network. Should we expect more of this? That's a slippery slope for a company that you don't want putting more money into bad companies. You want them to put that money into new growth companies that can be among those 10 or 15 names that he thinks can be huge winners 5 years from now.
That was Lightshed partner Walter Piecyk. Coming up, choose your spin. Peloton beats estimates on Tuesday, but analysts question the company's path to profitability. CEO John Foley says it is all part of the plan and hopes that Wall Street looks to the long game. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Peloton reported its first earnings this week. The company posted a loss, but higher than expected subscribers and revenue growth. Still, concerns exist over how fast the company is trying to expand. CEO John Foley talked to Bloomberg Tuesday after the report.
Our core bike business is profitable. It will be profitable over the next couple of years in the UK and Canada. We don't need to launch more products or more platforms or more geographies to that point to get to profitability. We may choose to invest in those things over time, but it's not something needed for profitability.
So did Foley's comments convince analysts? I got Rohit Kulkarni of MKM Partners on the phone.
The company did report a very impressive quarter. Objectively speaking, as in the numbers tell a very good story. As in the company is growing revenues 100% year on year, 5 quarters in a row. The company is having stable gross margins with rising gross margins on the subscription side of things. So things are trending in the right direction. The company is pedaling in the right direction. Make no mistake. But I think today, given the investor sentiment, investors, as we talked about Uber, investors want to see a pathway towards profitability. And I think the story here, what Peloton is telling the investors is that, look, we are going to invest heavily this year, bear with us for this year, and next year we are going to show a real progression along the pathway towards profitability. I think it's just about patience. It's just about how patient investors are willing to be and willing to accept the story today. On top of that, you are selling a very, very expensive product. We don't know how large of the addressable market is. And a year goes by, and if we are in a macroeconomic slowdown, then what happens to the pathway to profitability? That's the worry that investors have today, and hence they aren't willing to stick around with the patience that John is asking them to have.
And are you sticking around with that? Because the CEO did come out and say, look, we could be profitable tomorrow if we wanted to. We just don't think that that's the right decision, that we really do want to invest in growth at this point. Are you comfortable knowing that?
As in, over the longer term, I feel we would be comfortable. But today, what I think, given the investor sentiment, given heavy losses, given that the company just acquired a manufacturer based in Taiwan, they are overburdening their cost structure. They are investing in marketing, investing in a lot of things, and we feel we will wait on the sideline until there is a clear step towards the company generating some cash flow as a whole.
Rohit, does it comfort you knowing that the CEO said that they don't really have a lot of competition at this point?
I would take the other side of that, Taylor. I think from a competitive standpoint, yes, there is nothing like a Peloton bike on the market with the integrated ecosystem and the content and the big screens and the various different bells and whistles. But when you look at consumers looking to see where can I work out today, where am I willing to spend $100 to $150 a month, and what can I do? There are a lot of options. There are a lot of health clubs. There are a lot of fast-growing boutiques. And also there are a lot of at-home connected fitness products, be it Nautilus, be it Mirror, Tonal. So I think if you take a broader view of options that consumers have, I think it's getting more and more saturated. And history says that at-home fitness, we haven't seen a very long-term trajectory of that yet. Maybe Peloton is the one that is going to show that pathway, but history says we haven't seen that yet.
That was MKM Partners' Rohit Kulkarni. Lackluster stock performance from companies like Peloton and Uber, mixed with the implosion of WeWork's IPO, all make for examples of investors shunning money-losing startups. The banking sector is feeling the sting, too, as Goldman Sachs CEO David Solomon made clear this week. Goldman has investments in both WeWork and Uber. Solomon spoke to Bloomberg's Matt Miller in Berlin Tuesday.
It's important that you have a business model ultimately that can generate profitability, and I think there's a little bit more market discipline coming into play, and I think that's healthy for markets.
Bloomberg's Sonali Basak has her finger on the pulse of finance. I asked her about the notion that markets are becoming more adept at discerning whether companies have a clear path to profitability.
I think that the markets have been really irrational for a number of years now, just like David Solomon had just said, because of central banking policy. But as we get into the next leg of the central banking policy, frankly, this lower for longer type irrational behavior that's driving these sky-high valuations has to come to a reckoning. Because guess what? Everyone's not Amazon. And so now, finally, people are starting to tighten the reins. It only took one major flop for people to turn around quickly on that one. We've had the head of investment banking at Citigroup early September tell us that for Bloomberg Television as well. People were already starting to tighten the reins late this summer. And so that talk is getting a lot louder, certainly for banks like Goldman Sachs and JP Morgan that stuck with a lot of these companies through very tough times these last couple months.
And talk to me more about Jamie Dimon's comments from JP Morgan about this, where he really said private markets, those aren't real valuations because you don't have a price discovery. You just have an investor telling you this is what it's worth. What are your thoughts?
So not only that, Jamie Dimon is saying something very similar to what David Solomon is saying here, which is that one investor doesn't set a valuation, right? A market of investors sets a valuation. And so things can be pretty volatile and fickle until then. Jamie Dimon also said something that SoftBank is also addressing, which is changes in corporate governance. That's something we've been waiting for forever here in this hot market. And so SoftBank right now, according to the Financial Times, is thinking about tightening the reins in terms of corporate governance for the companies that it backs. And that's something you heard Jamie Dimon also address.
You know, Sonali, another story that all caught our attention here as we take a look at the tech landscape has been Robinhood Markets, which said, and there was a story coming out that basically put down a little bit of a deposit on margin and then you get infinite leverage. There's a glitch in the system. What is it?
So basically what's happening here is you have a certain set of Robinhood users who are selling calls, and that money is then being counted in that the user's capital. And so this is such a timely story, right? We're a week away from Money 2020 here. Thousands of people were meeting about the future of fintech. Once you're borrowing from a firm, you're becoming a bank and a personal hedge fund, right? So you're sitting here and you're having to deal with issues as you scale and grow. And Robinhood, as we know, is trying to not only grow, but has considered a banking charter as well. And so these glitches never look good in between, but they do say that it's isolated to a certain number of users. With that said, the users that have been doing this say that they've levered maybe a $4,000 investment into $1 million investment. And so they're pretty insane trades that we're seeing here that a lot of people are bragging about being able to take advantage of this glitch.
That was Bloomberg's Sonali Basak. Coming up, chipmaker Qualcomm reports earnings and things are looking up even as U.S.-China trade tensions continue. We'll explain next. This is Bloomberg. Chipmaker Qualcomm gave a stronger than predicted forecast for the first quarter when it reported earnings Wednesday. The company indicated that smartphone demand may be picking up after a prolonged slump. Qualcomm also projected strong revenue growth with 5G technology, which debuts this year with Samsung handsets. There's also Wall Street optimism over a renewed relationship with Apple for future versions of the iPhone and 5G. Bloomberg Technology's Ian King filled us in.
The whole conversation was about their outlook for the smartphone market next year, 2020. They're saying it's going to return to growth again. As much as 1.85 billion devices are going to be sold. And more importantly, 5G devices, as many as 225 million are going to be shipped next year, is what they said.
We also know that they're looking at what could be a fifth year of both sales and earnings decline. Is that due to the smartphone market? And if that starts to grow, could we start to see top and bottom line growth for Qualcomm? Yeah,
I mean, they could be back to growth year on year as early as next quarter if they hit some of their targets. But it's been a rough period for them. I mean, it's been this hideous kind of long drawn-out dispute with Apple that took away a big customer. They've also got a dispute with Huawei, which still hasn't been solved. And on top of that, you have people getting bored with their smartphones and not seeing anything exciting about new ones to the point that they did. So what they're saying is that phase of the smartphone market for them is over and things are going to come back. Just spoke to an analyst who said, well, that's maybe a little bit optimistic. So, you know, but so far, people like what they said.
And you mentioned the settlement with Apple. How much of a tailwind is that for the shares or the fundamentals for the stock?
Yeah, I mean, it means they're getting paid on licensing already. So even though they're not in the iPhone at the moment, they're getting paid a fee because their technology is, right? They already won that one. But it really won't cut in terms of their chip unit until at some point next year, probably this time next year when Apple comes out with its next version of its iPhone, when you'll see actual Qualcomm silicon in iPhones again.
You know, Morgan Stanley analysts coming into this call said the fourth quarter, which is what they reported, looked good, but it was really next quarter, that first quarter fiscal year, that might have been too optimistic. But if the shares are rising, do you get a feeling that maybe they weren't too optimistic? Are investors pretty happy that maybe the first quarter, that next quarter, is right in line?
Well, I think they're getting some credit for having been conservative about the quarter they just reported and then proved through their own execution that they actually did better. So that buys them credibility when they go out and say things are getting incrementally better again. And obviously people like that. People want, you know, this company to go back to growth.
And finally, just a top shakeup at the top of management. They are naming a new CFO. How big of news is this?
I mean, this guy has been with them a long time. He's been in the chip division, basically the head of the finance for that chip division. On the call, he answered a lot of questions. He was obviously very, very entrenched in the company and understands the business model. They're not getting an outside perspective here. They're getting a very much somebody who knows this company.
That was Bloomberg Technology's Ian King. And coming up, Disney gets ready to unleash its streaming service, but its earnings were on the radar this week. We get perspective on a global scale next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Taylor Riggs. This week we adjusted clocks and fell back in the U.S., and that means we now have the opportunity to check in with our colleagues at Bloomberg Daybreak Australia from our daily Global Link discussion. On Thursday, we focused on a company that is arguably the most global in reach and investment, Disney. The media giant reported its fourth quarter earnings Thursday, the last earnings report before the highly anticipated launch of its streaming platform. Bloomberg's Kathleen Hayes joined me in getting insight from Media Tech Capital Managing Partner Porter Bibb from New York.
The movie industry and the theatrical movie industry is not going to last more than 5 or 10 years as a viable business. But where Disney has positioned itself, it's going to be the dominant content producer, distributor, over the top and streaming going forward. And the market has finally caught up to Bob Iger and realized that Disney owns that space.
Yeah, so Porter, we could talk all about the earnings call and the earnings numbers, but frankly, here in San Francisco, no one cares. We just want to know about that Disney Plus TV.
Right.
What early numbers do you need to see to feel confident they can take on Netflix?
Well, they're going to lose money for at least 4 years, maybe a little longer. They're talking about by 2024, Bob Iger has said we'll have 50 million paid subscribers. The very smart thing that he did right away was price it at an irresistible level. And if you're a parent and you don't subscribe to Disney Plus, I think your kids will probably leave home. It's got so much recognizable and irresistible content. No one can touch the huge amount of library material that Bob Iger is making available for $12.99 a month.
A bargain. So
it's a real bargain, and he's thrown in ESPN and he's thrown in Hulu. So for that amount,
how can you go wrong?
You can't.
So what kind of revenue, what kind of profit and positioning can this earn for Disney?
It will become the biggest profit spinner 4 or 5 years from now. But right now, it's going to lose money as it lost almost $1 billion last year just in the startups, and each year until it breaks even, it's going to lose several $1 billion. But that's development costs, and that's actually money well spent.
Porter, we are hearing on the earnings call from CEO Bob Iger, and he's coming out and saying that there is no floor in sight for cable subscriptions. How much of a headwind from cable subscriptions can be offset, frankly, from a rise in streaming?
Well, it isn't the cable subscribers that are the concern. It's the retransmission fees that are worth billions of dollars to Disney and the other content providers. Just on ABC alone, he's going to start to lose literally billions of dollars from retransmission because of the serious cable cord cutting that's been ongoing and is only going to accelerate.
So you're still very positive on the stock. Is this a stock you own? Is this a stock would you buy? And you're also you're positive on online betting. We've
been in and out of Disney, and I think that what's happened is that Disney has gone from a day trader's stock and a market-influenced, rumor-driven stock to being a value stock, and that's where the market is going to find a huge appreciation in investing in Disney over the long haul.
And as you said, it never hurts to have your brand, your logo, Mickey Mouse, and others known by so many children of all ages around the world.
Here's a little number that you ought to keep in mind. Disney has a PE today of 17 times. The only other media company that's of any comparable size and content quality is Comcast. They're also at 17 times. Netflix has a 92 PE. And that suggests that since they have announced that they're going to spend $15 billion this year and more next year, they're not going to make a profit. And at 92 times, somebody is going to pick them up.
That was Media Tech Capital Managing Partner Porter Bibb with my colleague Kathleen Hayes in New York. And Expedia stock falls after the company posted its latest earnings report, citing Google algorithm difficulties. We hear from the CEO, Mark Okerstrom, a little later. This is Bloomberg. With just under a year to go until the 2020 U.S. election, Facebook COO Sheryl Sandberg told Bloomberg News on Thursday that things won't be the same this time around.
We think the 2020 election is a massive test for us. And it should be. You know, elections have changed. We've changed as a company. If you look back to 2016, of course we were prepared for state actors, but what they really did was hack in and take information. This new, more insidious, right, false stuff, we were totally unprepared. We never thought of it. We missed it. Everyone missed it. That's different now.
Now, with elections on the mind this week, state and local voters headed to the polls Tuesday. This is all as we began a one-year countdown to that 2020 presidential election. So how vulnerable are our election systems to hackers? It depends on who you ask. The U.S. government now says Russia, China, and Iran will seek to meddle in U.S. elections going forward. Hacking was one of the many topics we covered in a special electioneering series. Joining me Wednesday was a pair of ethical hackers, Alex Halderman. He's a University of Michigan computer science professor, successfully hacked voting machines in the past to prove vulnerabilities. And Harry Hursty, he's a white hat hacker and founding partner of cybersecurity firm Nordic Innovation Labs.
The biggest risk is that much of America's election infrastructure is badly out of date. There are many states that still don't have a paper record of every ballot, and many states that won't check those paper records where they're present. So there's a risk that sophisticated foreign hackers could break in and actually change the way votes are being counted.
Harry, do you agree that that is also the biggest risk?
It's one of the biggest risks, yes. The other part of this puzzle is that the U.S. voting machines generally don't keep a forensic evidence. So if there is a false claim of a foul play, these machines cannot really prove that everything went right. So in case that really requires that in order to have regain the public trust, that the risk limiting audit is conducted to prove that the results are the correct ones.
So, Harry, how do we get proof?
The proof really is all about, because all the voting machines we have today and all the voting machines we have in the foreseeable future are something which we can hack. They are literally computers, and that's why everything will be hackable. So the question is not to audit the machines. The machines have to be as good as possible, but really it's all about auditing the results and making certain that the public can trust that the results are the correct ones. So it's all about auditing.
Professor Alex, do you agree that we need to improve our auditing skills to ensure the security of the elections?
Well, that's one of the key components. We have to make sure that state and local governments implement basic cybersecurity, hygiene, and best practices. We have to make sure that there's paper backing every single ballot. And we've got to do audits that are robust enough to give us a really high probability of detecting any outcome-changing fraud.
Alex, you've mentioned paper voting twice now. Give me your thoughts on paper ballots versus electronic voting.
Well, electronic voting, unfortunately, was very popular a decade ago, and we had computers that just maintained every single record of the vote in a digital database. But all of those records, unfortunately, can be changed if a cyber attacker is successful at penetrating the voting machines used in a jurisdiction. With paper, you have a physical record that just can't be changed in a cyber attack. And in this day and age, it should just be common sense that you want to have that kind of physical backup to be safe.
So, Harry, talk to me as we look forward and try to make sure that these voting machines are secure. What role does technology play? Do we look at blockchain to help secure AI? Better cybersecurity? What role does technology play in securing those votes?
First of all, U.S. elections are uniquely complex, so U.S. elections cannot be conducted without using technology. However, a lot of technologies which have been proposed are very much unproven and unsuitable for securing election. For example, blockchain. Blockchain is really a solution looking for a problem, and one of the problems is not elections. We have a lot of peer-reviewed documents showing and studies showing why blockchain is fundamentally incompatible with election. The same way all the proposals which comes with online voting, we don't have a technology to do online voting. We don't have technology to do internet voting. elections are a uniquely hard problem because of the requirement of having secret ballot and auditability at the same time. So really we don't have any other technology than paper ballot, and then using technology to process the paper ballots and then audits to make sure that the technology works as it was supposed to work.
Alex, your take on the role of technology. Could you have something like AI or a blockchain, something that's secure and not hackable?
Well, blockchain is really good for certain things, for achieving a public record of past events that everyone can agree on. But really, in voting, well, I like to say that blockchain solves the problem of stolen votes just about as well as Bitcoin solves the problem of stolen money. Like, it doesn't. You can still have Bitcoin stolen if someone breaks into your computer, steals your password, or compromises an exchange. And it's the same when it comes to applying blockchain to voting.
That might be the quote of the day. So quickly here, a question to you both. Alex, I start with you. Facebook and Twitter in the fight on political ads, who is right?
I think Twitter has it right, that the safer thing to do right now is just to make sure that we're keeping political fights and potential disinformation at a distance from social media, especially when those political ads are a potential revenue source for the companies involved.
Harry, political ads, does Twitter have it right over Facebook?
I agree with Alex on that. Really, we don't have a human firewall. We lack a training for the voters and us as humans to have a capability of filter and use a source critic to the advertising we are shown. So at this point of time, keeping it out is the best way.
That was Alex Halderman of the University of Michigan and Harry Hursty of Nordic Innovation Labs. As for politics and social media, we covered the big line drawn ahead of the 2020 U.S. presidential election, also part of our electioneering series. In one corner, Facebook and CEO Mark Zuckerberg. He has spent a lot of time discussing why the social network will not police the accuracy of ads, citing free speech. In the other corner, Twitter and CEO Jack Dorsey with the total opposite stance. Last week, he banned all political ads on Twitter. With insight into how politicians leverage social media, I talked to Jason Rosenbaum. He's president of Seward Square Strategies. He was Hillary Clinton's digital ad director and a member of Google's political ads team. I also wanted perspective from Tim Cameron, CEO of FlexPoint Media and a former chief digital officer for the National Republican Senatorial Committee.
I think Facebook's right here, and largely the reason why Twitter decided to get out political ads isn't a moral one, it's a financial one. They only made $3 million last election cycle, which is basically a rounding error of all the online ad revenue that there is in politics. And this is an embarrassingly low number for a company that is arguably the most political social network in the world.
Jason, your thoughts?
Well, I think both companies' approaches are actually problematic. What we're seeing here is sort of an abdication of their responsibility. And this is an issue that we've dealt with other forms of media for decades. And what we're lacking is a legislative and regulatory approach to provide some guardrails for social media paid advertising. Local TV and radio stations for years have been prohibited from running factually incorrect advertising, and political advertising should be no different. And so what we need is for Congress and regulatory agencies to implement some kind of guardrails for this technology. The obvious first step here would be to pass the Honest Ads Act, which would provide true disclosure for political advertising so we know who is spending what and where.
Tim, I want to take a step back and take a look at Facebook in particular, who has taken a stance on this. Part of their ads are really hyper-targeted. And when you talk about this, we want to distinguish, how do you make sure that within those hyper-targeted ads that they are accurate? How do you go about doing that? Should we not do hyper-targeted ads? Should we?
Look, I don't think hyper-targeted ads are necessarily any more risky than broadly targeted ads. You can disseminate false information to a small group or a large group, but this is the cost that we pay for living in a free society. To quote Supreme Court Justice, or former Supreme Court Justice Anthony Kennedy, the remedy for false statements is the truth, and that's just the cost of living in a free society. To protect the First Amendment and to be able to get out there without prior restraint is something that's important, because if we start prohibiting ads, and you look at, say, somebody like Elizabeth Warren, who's completely in favor of Facebook taking on this role despite saying at the same time that they're way too powerful, you risk, potentially Republicans from being blocked from saying that her plan on Medicare for all will raise taxes on the middle class. And, maybe not this election, but down the road, that could lead to tyranny.
Jason, in your earlier comments, you brought up some of the local media coverage or radio where they're not allowed to run false ads. I wonder if part of the problem here is the ads on Facebook or some other sites aren't clearly marked as ads. Do we need to do a better job of presenting these ads for what they are, paid for by or list, and make it very clear that these are ads? Would that help solve part of the problem?
Well, we do have that. So federal election law requires that paid political advertising be disclosed, that there's a disclosure on those advertisements. And we should have that. But we should also have checks in place to ensure that political candidates, political organizations can't run factually incorrect advertising, knowingly do so. These are checks we've had in place for over 50 years for broadcast television and terrestrial radio. And we have a new technology with social media that's still in its infancy, and it's proven to be remarkably powerful in its ability to change people's opinions. And so we have to ask ourselves, are we going to provide some guardrails here? And if we are, and I believe that we should, are they meaningful? And I don't believe either banning political advertising or throwing our hands in the air and saying candidates can run whatever they want is meaningful reform.
Tim, in response to some of those comments that Jason was making, I also wanted to bring up a quote from Trump's campaign manager talking about the 2016 and the election and the role that Facebook played in that, where he said, I think Facebook is how we won in a lot of ways. I think President Trump won. I think Facebook is the 0.01% that delivered that message. If Facebook didn't exist, it would have been a lot tougher. Your take?
Look, I think that's absolutely true. I think it's a big reason why they won, and I think it's a big reason why a lot of campaigns have won. It's not the singular reason, but definitely a contributed one. But everybody's looking at this from the perspective of the presidential campaign, and the implications go much further down. In fact, a lot of what these social networks do is enable city councilmen and state house reps and smaller candidates to gain traction. And, what's so ill-fated about the move that Twitter pulled by banning political advertisements is that it's going to have a distinct impact on smaller, under-the-radar candidates like, say, Andrew Yang, who, suffered underneath a media blackout for months, and to prevent them from getting their message out. And so we really have to think through what the long-term implications are here, because this is bigger than the 2020 election. We're talking about the First Amendment, which is something that is just fundamental to our society and hopefully will be here for centuries to come.
Jason, finally here, as you sort of take a look out at the landscape and the Democratic committee, where are they in catching up with online spending? We remember Barack Obama was very tech savvy. He came out and was really able to get that niche younger audience, in part because of technology and social media. Where is the Democratic National Party on this today? Have they done enough?
It's been written a lot that President Trump is spending significant amounts of money online. He's the incumbent, and he has a large war chest right now. The Democratic candidates are spending significantly in early states and across the country, and I believe still far more sophisticated than many of the Republican candidates in the field.
That was Jason Rosenbaum of Stewart Square Strategies and Tim Cameron of FlexPoint Media. Coming up, Expedia shares fall after the company misses on earnings. What's ahead for the online travel company? We hear from the CEO next. This is Bloomberg. Online travel companies got our attention this week as TripAdvisor and Expedia reported earnings after the bell Wednesday. Both companies blame poor performance on decreases in Google search results. Expedia's vacation rental business saw a decline in revenue growth. Its president and CEO, Mark Okerstrom, joined Bloomberg Thursday to discuss strategy and outlook.
We did have a difficult quarter, but that said, there's a lot of great things happening around Expedia Group. We had a lot of highlights. Volume from room nights were up 11%. We continue to see great strength on our Expedia Partner Solutions business. We continue to make great efforts on our customer centricity initiatives, and it's starting to show up in our results. We did see our direct channels up more than the overall business, and we got a long runway ahead of us.
Let's talk about what's happening with the short-term rental business. There seems to be a concern that you are struggling to make your message heard on Google. How do you reduce your reliance on Google search?
Well, I think overall, whether it's our alternative accommodations business and VRBO or our other core OTA brands, a lot of it is around the strategy that we've got in place, which is making sure that we've got great products and services for our customers, that we build loyal customer relationships. We've got incredible loyalty programs. Hotels.com, for example, just hit their 50 millionth loyalty member. Brand Expedia's got a good rewards program. And importantly, it's about delivering incredible products and services for our customers, and that's exactly what we're squarely aimed at doing. VRBO itself, which is our alternative accommodations brand, as you know, has just relaunched its new brand. They're looking at relaunching or launching that in other regions around the world. And ultimately, we've seen good strength there. The VRBO brand itself has been up nicely double digits. And again, we're going to continue to move along with our multi-channel strategy that, really isn't a strategy that is solely dependent on Google.
Mark, how much more are you going to spend on marketing, though, with VRBO? Because it is taking some time to sort of have this rebranding accepted and known by the public, and particularly now with this new challenge of Google putting Hotel Finder above the likes of VRBO in search. That makes it much more difficult for you. I think the street and investors want to know, when will that happen? How much will it cost for that to happen?
Well, we're going to do it in a balanced way, in which is the way that we've always done it. We have spent against the VRBO brand in the U.S., both in traditional television, digital. We are seeing good results there, and as we look to roll it out internationally, we're going to continue to do it in a balanced way. But of course, our alternative accommodation strategy isn't just about VRBO. We have recently brought some of our partner-facing teams closer together. We are now up to 650 alternative accommodations offerings from VRBO available on our core OTA brands. And so international expansion for us in alternative accommodations is going to be a real combined effort.
That was Expedia President and CEO Mark Okerstrom. And that does it for this edition of the Best of Bloomberg Technology. We'll bring you all of the latest in tech throughout the week. Tune in each day, 5 p.m. in New York, 2 p.m. in San Francisco. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.